Thanks for joining us today in the close. I'm Morella Fernandez. Markets close in 30 minutes. Let's get to the stories we're following in the BNN Bloomberg newsroom. Canada's economy stalled in November with GDP flat compared to the month before. Economists had been expecting a rise of 0.1%. Data from StatsCan shows the drag came from goods-producing industries, which fell for the third time in 4 months. Now, services industry saw an increase driven by higher retail spending. Looking ahead, StatsCan says GDP likely rose 0.1% in December. Shares of Bombardier taking a hit today after the U.S. president threatened to impose a 50% tariff on aircraft from Canada sold in the U.S. In an online post, Trump accused Canada of refusing to certify some jets made by Gulfstream and threatened to retaliate by decertifying Bombardier Global Expresses and all other new Canadian aircraft. The industry minister, Melanie Joly, says Canada's aviation regulator is in the process of certifying Gulfstream jets. Shares of Canadian National Railway tracking lower today after the rail operator's full-year outlook came in at the low end of expectations. CN says it expects volume growth to be flat this year and expects profit to slightly exceed volume growth. Now, on the bright side, the company did report higher profit and revenue for its fourth quarter, thanks to better freight volumes and improved operational efficiency. CN also boosted its dividend by 3%. Shares of Imperial Oil are in the red today. The oil producer and refiner posted profit and revenue in its latest quarter that fell because of lower oil prices. Imperial's net income plunged 60% because of a write-down on an aging oil field. And production from its oil sands assets in Alberta also dropped because of weather conditions. Now, despite a disappointing quarter, Imperial raised its dividend by 20%. A dismal day for the TSX today. It's down 1,138 points so far on the day. That's about 3.5% down, and it's now in the $31,000 range. Let's move south of the border, where it's also a streak of red. The S&P 500 has a 45-point move down today, about 0.6%. The Dow Jones, 228 points down, almost half of 1%. And the Nasdaq, a 276-point drop, 1.2%. Here's part of the reason why. Gold futures down quite a bit, 8.75% so far on the day. That's a $469, almost $470 drop there. It's moving around quite a bit after the run it had last year and the start of this year. Let's go to silver. It is tanking today as well. It's down 27, almost 28%. That's a loss of $32 an ounce, down to $82.42 right now. Canada's economic growth stalled in November. There was weakness in the goods-producing sector, and that weighed on output. Let's go to Robert Kavik. He's Senior Economist and Director of Economics at BMO. Thanks for joining us today.
Sure thing. Thanks for having me.
What was the read on the main factors behind missing the estimate for November's GDP?
Well, there were some issues in manufacturing. We had some auto plants kind of shut in, and you just generally have an economy that's been struggling kind of under the weight of the trade tensions. So regardless of the November print, which was flat, we got a slightly better read in December. The reality is that the fourth quarter is looking like we're going to struggle to get any growth at all. In fact, we could very well see a negative number. And that's that and just the choppy nature of activity right through all of 2025. And as we head into the early start of 2026 is just reflective of a lot of uncertainty out there in the economy. A few sectors weighing, a few sectors performing relatively well, but overall an economy that's just kind of growing below the speed limit, below the potential rate of growth that we see in Canada.
The retail growth for November, was that basically sort of a holiday push-up, you think?
Well, possibly. And the consumer generally has been holding in relatively well. Like domestic demand in Canada, especially in the consumer space, has been okay. And I think, the fact that interest rates have been, cut 275 basis points through the course of late 24 and through most of 2025 has kind of set us up in a better environment for the consumer overall. So like, regardless of hanging up on 1 or 2 months of data there, the reality is that 2026 should be all right. Lower interest rates, pretty solid real wage growth. And yes, a pretty big wave of mortgage renewals. But overall, I think the Canadian household, especially with a pretty strong balance sheet, has proven that it's going to be able to handle those renewals pretty well. And real, consumer spending should continue to grow, at least at a pretty modest clip, but growing nonetheless.
Do you think then we are through the first round of tariffs that threw us a spiral last year? And I ask because, of course, Donald Trump has only recently said 100% markup on Canadian goods and then now on Bombardier jets. So let's talk about the first big push of tariffs that came sort of in last spring. Are we through most of that?
Well, for the most part, the economy has been able to absorb that. And one of the reasons is that a lot of those tariffs have been kind of sheltered under the cover of the USMCA agreement we have now. So with the exception of a few pockets, whether it being auto parts or steel and aluminum, which are still obviously subject to pretty significant tariffs, for the most part, the economy has been able to absorb that. I think the bigger issue, though, isn't, whether or not the economy can handle a 5 percentage point increase in the weighted average tariff or whatever the arithmetic says, which is about roughly that level. The bigger issue is that a lot of Canadian businesses just still going into 2026 don't know what the rules of the game are going to be through this year, possibly through the year after that and beyond. And it's really hard to go out there and make big hiring decisions or big capital spending decisions when you don't know what those rules of the game are going to be. So until we get some firm clarity and some credible clarity on the state of Canada-U.S. trade, presumably as we go into July and then USMCA comes up for renewal, I think that cloud of uncertainty still kind of hangs over the economy.
Okay, so the idea is that some sort of renegotiation does bring that clarity. But as you said or referred to, it can't really be certain about that. Donald Trump changes his mind about things routinely. And even if, he came up with CUSMA and doesn't like it now. So do you feel that really business decisions are going to be stalled until his term is over?
Well, so the biggest hurdle will be what happens over the next couple months into renegotiations, right? If we get something that, as I said, looks credible on that front, it's going to help. But to your point, I mean, we very well could be in an environment beyond the middle of this year, assuming we do get some kind of trade agreement where the business sector just really isn't quite sure, right? And I do kind of think that kind of locks us into, a run rate for economic growth, especially like on the business investment side or the side of the economy that is sensitive to those tariffs and that trade relationship, to a run rate that's probably a little bit flatter than we otherwise would see. And I do think there's a risk that persists, yeah. Okay.
Stats Canada is looking at the Canadian economy squeezing out some growth in 2026. Are you on side with that?
Yes. 2026, we are, kind of the view that we do get growth in around the 1.5% mark. So again, it's not robust by any means from a Canadian perspective, but we have the consumer holding in relatively well. We have a pretty significant wave of fiscal stimulus that's going to be hitting the economy. In fact, this week, policymakers have even added a few $1 billion more of fiscal stimulus through programs like the GST rebate. So the job market has, kind of shown some signs that it's stabilizing. And I mean, yes, we have that trade uncertainty. We have a relatively stagnant housing market, but all things considered, we do think we're still, grinding out economic growth here, even if it's not, especially robust.
Okay, Robert, I'll leave it there. Appreciate you joining us today. Robert Kavik, Senior Economist, Director of Economics at BMO. After the break, we will dive into what is driving that big drop today for the TSX and other North American markets. We're back in a moment. Sell-off in equities and precious metals led to significant declines across North American markets. Have a look at the TSX. It is down 1,100 points right now, taking it back down under 32,000. Remember, it was up above 33. And take a look at some of the other markets in the U.S. S&P down about 0.5%. The Nasdaq down over 1% at this point. So should investors be worried, or is this just a blip? Let's go to Young Yu Ma. He's Chief Investment Strategist at PNC Asset Management Group. Thanks for joining us today.
Thank you. Great to be here.
We had always expected, many analysts had expected gold and silver to come down. There would be a correction. You're seeing it come off quite a bit today. Is this just the strength of the U.S. dollar or something else at play?
Yeah, it's a very sharp move we're seeing today, no doubt about it. And silver, the sharpest move in decades. I think there's a few things in play here. I don't actually think the strength, it's quite modest strength we're seeing in the dollar today, and a reversal of some of the weakness we've seen in the past couple of weeks. I do think that was a trigger for today, but I don't think that it explains the move. I think ultimately what's taking place in precious metals is that there had been too much froth in some of those trades, probably too much leverage, and people who were positioning too aggressively. And once that started to turn down, that momentum built on itself, and you're probably seeing overly leveraged positions being unwound now. So I think it'll find a level where it stabilizes, but I do think that right now we're seeing that kind of volatility that's very extreme because of the froth that was built up.
Okay, let's get to some concerns that still exist around tech and the big Meg 7 as part of that. Despite some positive results already this week from Microsoft and Apple, investors aren't liking these stocks much better. Tell me what you see beyond those quarter results that perhaps investors are tuning into.
Well, investors didn't like Microsoft's results. They were okay with Apple's results. I think they liked Meta's results. So it's a mixed bag, and I think that's noteworthy. And what we'll see more of this earnings season and for the rest of this year is that kind of dispersion. And investors in the market really looking to see who is seeing payoffs from these big AI investments that they're making, that these companies are making. Some companies are seeing early payoffs, and the market's going to reward that. Some companies, that payoff might be either a bit further out or in question. And I think the market is going to take a more skeptical eye this year to see that massive amount of investment, especially from mega cap companies, but from a lot of companies, that's actually starting to see benefits, and the trajectory remains one of growth and efficiency from that spending. So I think the market's going to be more exacting this year. I think that's a theme for 2026.
Okay, so how are you positioning in tech? Are you keeping with the hyperscalers? Are you trimming on that and moving elsewhere down the line?
We like diversification. We like the AI theme. We don't think it's going away. We think it's here to stay, and it has a very long runway. But we don't want to be overly levered to any one area of AI or any one, certainly not any one company. We think there are going to be a lot of winners. It's going to be pretty broad-based, and that strength and benefit and efficiency from AI is going to proliferate throughout the economy, not just the technology names. But we like that area, but we want to stay highly diversified within AI. If we remember from the lessons of the late 1990s and early 2000s, some of the early winners turned out not to be the long-term winners. Some companies that weren't even on the radar in the mid-1990s or even late 1990s turned out to be big winners. So it's important to be diversified in this area. We know there's going to be a lot of shakeups, a lot of dynamism in the space. So we want to stay exposed, but we want to stay very well diversified.
Okay, so are you looking at opportunities for investment outside of the U.S.? If so, where and why?
We do think internationally is an increasingly important place to look for diversification. Part of that has to do with some areas of growth, such as emerging markets. There are some areas of resources in South America that are valuable to support some of the growth in the rest of the world as well. But even Europe, there are some areas where you see kind of the convergence of fiscal stimulus and governments willing to spend and valuations where it might not be as stretched in some areas. So we think that diversification is especially important now. We think we're probably actually going to see lower correlations between international markets and North American markets this year than we've seen in the past. And that lower correlation is beneficial for portfolios as well. So it's a combination of technology, a combination of growth, fiscal stimulus, natural resources. We think there are various elements, but that diversification internationally is more important than ever this year.
Okay, I also want to get your take on the U.S. Fed chair picked by Donald Trump. That obviously bolstered the U.S. dollar today, but what do you think it means moving forward for the rate of cuts?
I don't think it actually changes the trajectory much. I think at the end of the day, there are many voting members on the Fed. They're going to be looking at the data. They're going to be assessing the trajectory of inflation, not just the historical data, but how much AI, for example, and other technologies might be helping to bring down inflation. They're going to be assessing the labor market. I think ultimately they will settle on the same path that they would with a number of different potential Fed chairs, because you do have a committee that votes, and these are all very serious and thoughtful people. So I think there's a knee-jerk reaction sometimes. It's perhaps bigger than warranted. There was also a knee-jerk reaction, if we recall, when Chair Powell was nominated as the Fed chair many years ago. The question then was, does someone of his background and business experience, is he going to be someone who's able to lead the Fed and interest rate policy well? And we think that is proven to be the case. So oftentimes these knee-jerk reactions aren't as warranted or aren't as concerning as they play out to be in the future.
Young Yu, thanks for joining us. Appreciate your time very much on this Friday.
Thank you. Great to be here.
Coming up next, we finally found out, as we mentioned, who the next U.S. Fed chair will be. So we'll dig into that a little bit more when we come back. With inflation still squeezing household budgets, Canadians say cutting grocery costs now outweigh housing concerns and housing concern costs. This is coming from a new Nanos research poll. Alex Carper has more.
Hard to make decisions.
A trip to the grocery store is not an easy one for Ben Nye.
It's really expensive here.
Soaring prices at checkout are forcing him to carefully consider what meals he can afford to make.
That's not bad. $4.99.
Being currently unemployed and searching for work has made it a struggle to pay the bills.
As a consumer, we're being hit hard, and it's being difficult for us to actually be able to afford anything anymore.
Nye has even resorted to selling many of his things just to cover costs.
It's difficult trying to make ends meet.
Like Ben, many are feeling the impacts of rising grocery prices. A new survey finds that the biggest concerns around costs for Canadians is right here at the grocery store. A new Nanos research poll for CTV News finds grocery prices worry Canadians more than housing costs as inflation continues to rise. More than half of Canadians say groceries are top of mind when looking to save money this year, followed by housing at almost 25% and healthcare at nearly 10%.
It speaks to the pressure that Canadians are under and how groceries are at the top of the list, significantly ahead of things like housing and healthcare and fuel and entertainment, all those things.
But experts warn that relief may not come anytime soon.
The story on tariffs are going to continue as we're trying to renew CUMSO with a very unfortunate negotiating opponent in the United States. Could be looking at, a bad year next year as well.
Let's try this.
As prices continue to climb with no end in sight, Nye says he will do whatever it takes just to stay afloat. Alex Carpa, CTV News, Winnipeg.
The day Oshawa, Ontario auto workers have dreaded for months has arrived as GM Canada is poised to cut a shift at the city's plant, costing over 1,000 workers their jobs. CTV's John Vanavelli-Rao has more.
At this GM plant, the plunging temperatures outside match the mood of its workers feeling left out in the cold.
Feeling bad because you got bills to pay.
At the Oshawa plant, 500 full-time GM jobs are being cut, along with hundreds more in the supply chain.
I feel really bad. My son's losing his job. He was hired in 2022.
Back then, a third shift was added amid heavy demand for the Chevy Silverado trucks built here. That extra shift, though, is being eliminated on Friday. GM announced the change was coming 8 months ago, not long after the U.S. president brought in tariffs aimed at the auto sector. In a statement, GM confirmed Oshawa Assembly will return to 2 shifts of production, but adding it's also continuing preparations to build the next generation of gas-powered full-sized pickups, reinforcing Oshawa's future. Still, while GM says it's committed to staying, the union says some truck production is being shifted to this plant in Indiana.
It's devastating news. We have a large portion of our membership that won't have a job come tomorrow morning at 6:30.
It's just the latest blow after GM last year idled this plant in Ingersoll, Ontario, and Stellantis shut down a plant in Brampton. Hoping to give the sector a boost, Ottawa has agreed to potential future talks with South Korea that could include automaking. According to Hyundai and Kia, they sell annually around 250,000 vehicles in Canada, yet don't manufacture here. Still, some think a deal could draw the ire of the U.S. president.
Trump is coming after investments that are going anywhere other than the United States. So to announce a $3-4 billion investment in the Canadian market right now isn't exactly going to help the image in the United States, and it might put a target on your back south of the border.
Meanwhile, some at this GM plant are hoping the third shift could be reinstated if Ottawa reaches a trade deal with the U.S. Jonathan Valley-Rouse, CTV News, Oshawa.
Let's have another last look at the markets before the end of the trading day, the end of the trading week. It's a dismal one in Toronto. The TSX dropping 1,100 plus points right now. It's down 3.4%, and from highs above 33,000 now to 31,891 ahead of the end of the day. South of the border, the same situation, but not as drastic. The S&P 500 down 29 points today. The Dow 173-point drop. That's 0.4 of 1%. The NASDAQ almost 1% down with a 228-point drop. Here's part of the reason why. Gold and silver taking big hits. They haven't seen this kind of hit in decades. Gold down 9.8% today. That's a $520 drop. Taking gold to about $4,800 an ounce, just plus. Silver, look at that, 28% down. That's a $32 drop, almost 33. But look at the run up it's had over the last year, 160% up. Many had predicted both gold and silver would correct, and the correction for silver here is quite dramatic. All right, we'll bring you the stocks that moved and the ending day numbers when we come back. Stay tuned. Here are the closing bells for the end of the trading day and the end of the trading week. At the NASDAQ, Ether Holdings ringing the closing bell, and in New York, Church and Dwight ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. Pretty dismal one for the North American markets, but the TSX, the biggest hit here. It's down over 1,000 points, 3.3% on the day, and sinking under 32,000 points today. The S&P 500 just a 29-point move down today, but the NASDAQ almost a full percent down. It's a 223-point drop for the NASDAQ today. Let's get to some of the movers in Toronto. We can see the trend deep in the red with precious metals here. Silver core metal down 16%, $2.63 per share, taking it to $13.71. New gold, with gold down today, 16% drop, $2.65 lost per share, $13.68 is where it lands. First Majestic Silver also down over 16%. Look at where it was over the year, though, 253% up. So a $5.58 loss today per share for First Majestic Silver. Endeavor Silver also taking that hit. It's down 16% as well, $2.86 down. And then in the green for growth today, Brookfield Renewable. It's up 6.8%. $3.63 up to $56.71. Let's bring in Bloomberg's equities reporter Stephanie Hughes. She joins us now to talk about what has been a very sad ending to the week. Dismal end for the TSX, but tell me how this played out from the start of the day.
Yeah, that's right, Merle. I was going to say happy Friday, but I guess it's not really that happy for the TSX. Those shares, or the whole index, fell by nearly 4% at its lowest point, which marked its worst day since the market turmoil in the wake of the Liberation Day tariffs last April. And so today's rout is driven primarily by falling precious metals prices, which you kind of mentioned there with the miners being down. And that came after Trump made his pick for the Federal Reserve chair. And I'll get to more detail about that in a second, but it is interesting how volatile this index is, or gold and silver are, just given that it was gold and silver miners that helped propel the TSX to outperform its U.S. counterpart last year and to kick off this year. But today, pretty much the entire swath of the worst performers on the TSX were gold and silver miners, dragging down the index, just given how heavily it relies on the materials sub-index, which has about a 19% weighting. So yeah, the shine really came off the precious metals there, Marilla.
Yeah, not unexpected, as you alluded to. Aya Gold and Silver, one of many of those stocks that took a hit today. How low did it get to?
It fell by nearly 18% at its lowest point. It was one of the worst performers on the TSX before they all started trading places, but that still marked its biggest decline since September. And that it's crashing down in tandem with other names after President Donald Trump said that he intended to nominate Kevin Warsh as the next chair of the Federal Reserve. And Warsh has had a bit of a reputation as an inflation hawk, but kind of changed his tune last year when he publicly expressed lower interest rates. Still, it's that hawkish reputation that has traders believing that he might not be as aggressive with cutting interest rates. So that caused silver to plunge by about 20%, its biggest intraday decline since 2008, and gold fell by over 10% at one point, crashing below that $5,000 an ounce level that it had only recently actually just come above. So that's the precious metals, I should mention, tend to benefit from lower interest rates because it is an asset that doesn't pay interest. So that's sending a ripple across the precious metal space on the TSX, moving Aya Gold and Silver lower, New Gold, Discovery Silver, and so many more. That in turn knocking down the TSX, as you mentioned, Marilla.
All right, quite a knockdown. Let's get to another thing that knocked the TSX down was Bombardier. It got dragged down. Thank you very much, Washington. Walk us through it. Walk us through what happened here.
Yeah, Bombardier got its wings clipped a bit. That the private jet maker saw some turbulence in its stock, falling as much as 11% today. That also marked its biggest intraday decline since last April. And that's because, once again, Donald Trump's story, he threatened to put a 50% tariff on Canadian aircraft and to decertify all new Canadian aircraft, or all aircraft made within the country, including Bombardier Global Express jets. So that's his way of retaliating against Canada, who he said, saying the government refused to certify certain jet models made by Gulfstream. And that's a particular problem for Bombardier, since about 64% of its revenues in 2024 came from the U.S. It's a massive market for that company. And this drop today that we're seeing follows a 9% plunge earlier in the week after one of its aircraft crashed on takeoff in Maine, and Goldman Sachs downgraded it to a sell rating. So this week has been very unkind to Bombardier, that had already been, or like a name that's been on an over 200% rally over the past year as of Friday before hitting this week, and then that reversed some of its fortunes a bit. The company did say it was in contact with the Canadian government, and today we saw Industry Minister Mélanie Joly saying that certification work was well underway. Analysts acknowledged that shares would come under pressure. It would be more of a sentiment play, but they were also skeptical that Trump would actually move ahead on decertifying Canadian aircraft, because it would just be easy for Canada to certify the U.S. aircraft that Donald Trump wanted. Also, tariffs would be harmful to the U.S. industry as well. And on top of all that, it would just mark a very unprecedented move, Marilla.
All right. It would be unprecedented, but we know he likes to do those unprecedented things. Bloomberg's Stephanie Hughes, hopefully you have a quiet weekend. Thanks for joining us.
You too. Thank you.
So markets, as you saw, closed lower today after things coming out of Washington, things coming out of Donald Trump. He also did tap a new successor for Jerome Powell, finally. We'll talk about that in a moment. Markets in the red today, despite the U.S. president finally nominating Kevin Warsh as the next Federal Reserve Chair. He is expected to lower interest rates, or at least support that in the short term. Let's go to Scott Wren, Senior Global Market Strategist at Wells Fargo Investment Institute. Scott, thanks for joining us today.
Good afternoon.
So investors seem to like this pick by Donald Trump for the chair, but they are reversing course in a big way on precious metals. Why the retreat?
Well, I think that for one thing, precious metals have obviously had just a huge run. And I think the market's still really debating. If you go back to when Kevin Warsh was a Fed governor, he was more on the hawkish side. And so I think he has, certainly come over toward President Trump's view that interest rates need to be lowered. I think it was more of an excuse that, well, maybe this isn't going to be as easy as we thought if, Kevin Hassard or somebody like that was nominated. So I think it's with the precious metals, it's mainly a situation where, the dollar's stronger. Precious metals are down, and maybe the Fed's not going to be quite as dovish as some people had thought. That could be just the excuse, though, for the day.
Okay, that's true. We won't know till Monday. Let's turn our attention to big tech, because there's still clearly an overhang for investors. Apple, big bump from iPhone sales, record sales for that, but the stock is down. So what's going on?
Yeah, I think, it's a similar thing, really, to be honest with you, as precious metals, where you've had such a run in these stocks. And granted, we've seen a broadening market. On a year-to-date basis, Infotech had trailed. But I think that the Mag 7 is certainly going to participate this year. But we think that in terms of prices that take the S&P higher, in terms of earnings, you're going to see broader participation from a number of other different sectors. We actually are back down to even weight on tech and communication services. And the sectors we're overweight in right now are financials, industrials, and utilities. So we want to keep that AI theme, but we want to look at some other sectors that are going to benefit as all this CapEx spending and AI benefits kind of trickle down through the economy.
Okay, so we've seen the beginning of some of these big tech companies report. You think it'll be the same next week when we hear from others? And
I do. I think, it's kind of funny because all last year, and obviously, this is the fourth quarter we're hearing about now. All last year, the market was a little bit nervous about these companies backing off of their AI CapEx plans, and all they did really was just tell us every quarter that they were going to increase it. And so they're still going to spend a lot of money. But of course, the market's starting to turn around. They're going, okay, the spending's big. When are we going to see some results here? When is this going to drop to the bottom line and boost EPS? And, you hear companies like Meta say that, this year they're going to spend $115 to $130 billion on AI infrastructure. I mean, that is a huge number from one company. And so I think the market does want to see some results. It's cut these companies some slack. But this year, and probably particularly next year, the market's going to want to see some earnings on the bottom line. They want a return on investment for all this money that's being spent.
Okay. You favor the large and mid caps right now. I know small caps have had a bit of a comeback over the last month or two, but why aren't you looking at small? Why are you remaining in large and mid?
We had been underweight smalls for a while, and that worked pretty well. And they performed a lot better last year, really, than what we thought they would. And we've stuck with that quality theme. So that's a vague term, but for us, it means good balance sheets, lots of cash flow, lots of products, easy access to credit. They're buying back shares. that's not really where Russell 2000 stocks are if I generalize a bit. So I think normally in a cycle when you would have been coming out of a recession or a meaningful slowdown where earnings contracted and the economy was very slow, people want to take more risk. Monetary policy is usually pretty effective, and small caps outperform for the first couple of years in the cycle. But this time we really didn't have much of a slowdown. I think that what really fired up small cap stocks was just the thought that the Federal Reserve was going to lower interest rates more than they probably will. So last year, I think, and really the last few months, I think that was more of an aberration. And I think when 2026 is all over and done, large and mid caps are going to outperform smalls this year.
Okay. What are you doing with fixed income right now?
Well, fixed income, we've been stuck in that 3 to 7 year maturity. That's the maturity range that we like. Technically, we're underweight the short end of the curve. We think the Fed is going to cut a couple of times this year. And then we think long rates are probably going to rise a little bit, not a lot. So we've also been underweight the long end. So we like that 3 to 7 year maturity. And once again, it's kind of quality. It's investment grade corporates. It's essential munis. Things like that. So we're still on that quality, dependability type of theme that we've really been on for a couple of years now.
Okay, Scott, I'm going to leave it there. I'm out of time. Scott Wren is the Senior Global Market Strategist, Wells Fargo Investment Institute. Thank you, sir.
Thank you.
Coming up next, the latest terror threat from Trump, this time Canadian aircraft the target. Back in a moment. Some more very big terror threats coming from Donald Trump today, this time for Canadian aircraft. Let's unwind with John Graddick. He's an aviation expert, and he joins us now to talk about this. John, thanks for joining us today.
Good afternoon, Marilla.
How did you take this threat to decertify some Canadian aircraft?
Oh, I think that this is a commercial spat that's developing between Gulfstream and Bombardier. Bombardier has been outperforming Gulfstream sales in the U.S. significantly with the 7,000, the 7,500, and now with the 8,000. Our friends at Gulfstream are not very happy with this competition, and they managed to get their audience with the president to come up with some wording in a missive last night on Truth Social that put the blame of this uncompetitive situation on the hands of Transport Canada certification.
Yeah.
So it really was a commercial spat that's kind of blown out of proportion at this point in time.
He's making accusations, as you said, about Canada dragging its heels essentially on Gulfstream Jet's approval. How long does this process typically take?
Oh, it could take years. The Gulfstream 700 and the Gulfstream 800, have been launched many years ago. It took the U.S. FAA 4 years to really go through all of the hoops and bells and whistles that are required to certify that airplane. So it's a long process, especially when you bring in new equipment, new technologies, new systems on board, which the Gulfstream did, as did Bombardier. And so it's a long process. The regulators got to do their job, and Transport Canada is doing its job, with a lot of diligence. It's not that they don't trust the FAA in terms of their certification, but I think Canada is taking the right road in taking its time to make sure that this airplane is safe to operate and carry passengers in Canada.
So would you say Ottawa is dragging its heels?
Excuse me?
Would you say Ottawa is dragging its heels on this?
Yeah, the issue seems to be fuel, right, on board the airplane, on the Gulfstream airplanes, and I think that the fuel situation needs to be addressed. I think the U.S. and the Europeans have allowed this airplane to be certified with exemptions. So the exceptions was, to make sure this airplane is, as far away from cold weather as it possibly can in order to prevent freezing up of the fuel systems. So that's where we're in a situation where Canada says that's not an acceptable process. We don't deal with exceptions. Fix the airplane, please, Gulfstream. And when it's fixed, come back and we'll certify it.
Got it. Okay, so there is an actual reason given for perhaps this perhaps its approval going a little bit slowly. Would it make sense for the U.S. to stop bringing in aircraft from Canada? What would that impact look like?
Oh, the question you have to ask yourself, for the U.S. to kind of back off what they've done in this latest mess, there's still a 50% tariff that is hanging over Bombardier airplanes. That would be a death knell, from in my opinion, to Bombardier. It would be something that would price their airplanes out of the market completely, and yet open the door for Gulfstream to recapture some of its lost market share. But I think that's still a question mark. Is the tariff going to be real, or do we have another situation where the president might just back away from doing the tariff?
You mentioned that the Bombardier aircrafts are popular in the U.S. How popular? How many of these do they sell? Can you give me an idea of how much the U.S. relies on them?
Oh, these airplanes are bestsellers. Bombardier has sold hundreds of these airplanes over the last few years, and I think that you look at there are fractional jet fleets that are around there. You have some charter jet fleets, and the most of the sales to those fleets have been Bombardier airplanes. It's a beautiful airplane. It's comfortable. It's spacious, and it's got high ceilings. It's got electronics and components, and just the general building style of the airplane is so much different than Gulfstream. So Gulfstream is seriously behind the times when it comes to a competitive aircraft to Bombardier.
Melanie Joly, the minister, has said she thinks this can be resolved. How do you see it resolving itself?
That's a good question. I think that there's been a lot of rhetoric going around in the last 18 hours or 20 hours about this event, and I think that cooler heads have to prevail. I think Transport Canada has been instructed not to comment. I think Bombardier is keeping its comments to itself in this area, because they know that it doesn't add it'll just add fuel to the fire. We're trying to resolve this thing through political channels as best as we can, and I think that we might be in a situation where Canada might have to, in fact, pull a proposed retaliatory action to get the Trump administration to really take us seriously, that this is not the right way to go about developing a North American aerospace market. I think that I've been talking today about potentially looking at trying to stop U.S. commercial aircraft from using Canadian airspace. And that's wholly within the Canadian government's capability to do that. But that would certainly send a message to Mr. Trump, would send a message to the American population that, you need Canada. You need Canada to basically make sure that your economy and your travels arrangements are made. And, exercising our sovereign rights over Canadian airspace is something that's definitely within our capabilities.
John Braddock, I'm going to leave it there, sir. John is an aviation management, supply chain management lecturer at McGill University. Thanks for that. Up next, some of the Mag 7 selling off today after reporting earnings. We'll get into the details when we come back. Here are the stories we are following today. Canada's economy stalled in November, with GDP flat compared to the month before. Economists were expecting a rise of 0.1%. StatsCan says the drag came from goods-producing industries, which fell for the third time in 4 months. And service industries saw an increase driven by higher retail spending. Now, looking ahead, StatsCan says GDP likely rose 0.1% in December. Shares of Bombardier under pressure today after the American president threatened to impose a 50% tariff on aircraft from Canada sold in the U.S. In a post, Trump accuses Canada of refusing to certify some jets made by Gulfstream and threatened to retaliate by decertifying Bombardier Global Expresses and all other new Canadian aircraft. The industry minister, Melanie Joly, says Canada's aviation regulators in the process of certifying Gulfstream jets. Gold and silver took a deep slide today. Spot gold falling 10%, its biggest drop in decades. Silver plunged more than 26%. The sell-off seems to be triggered by the U.S. dollar rebounding after Trump said he intends to nominate Kevin Warsh as the next U.S. Fed chair. The precious metals reached record highs and earlier this month as trade and geopolitical tensions rose. Canadian National Railway giving a full-year outlook that came in at the low end of expectations. CN says it expects volume growth to be flat 2026 and expects profit to slightly exceed volume growth. Now, on the upside, the company reported higher profit and revenue in its fourth quarter and also boosted its dividend by 3%. We've had some of the big Mag 7 companies reporting this week. We will expect some others to report next week and after that. So let's talk about what happened with Angelo Zeno. He's equity analyst and senior vice president at CFRA Research. Thanks for joining us today.
Thanks for having me.
So Apple had an iPhone blowout. The i17 is doing really well. Still, stock is down. So what are investors seeing that they don't like?
Yeah, I mean, I think when you look at Apple's numbers, I mean, they were absolutely fantastic. You pointed to the iPhone numbers grew, I think, 23% year over year. It was the best number that we had seen since the iPhone 12 cycle when everyone was dealing with a pandemic, and we had the 5G cycle where they actually increased prices by about $100 on that side of things. But you kind of look here this quarter. I mean, it's fantastic. The guidance was really good, better than expected, both on margins as well as revenue. I think the concern from the street right now is some of the pressures on the memory side. Apple obviously doesn't give a guide past the March quarter, but they did hint at the fact that, hey, listen, memory pricing is going to have more of an impact after that March quarter. So they're dealing with some of the constraints very well right now. They're actually somewhat constrained their own selves for other components just because the demand is so strong for the iPhone. But nonetheless, I mean, I think it largely has to do with some of the memory pressures, as well as the fact that you're going to bump along tougher comparisons as this year progresses.
Okay, but producer just mentioned that they did squeeze out a win in the end of the day. They're up like $1 today. Okay, you still have a buy rating for them because you think what they have in the pipeline, like the partnership with Google, will really benefit them?
Yeah, I mean, I do think AI is going to be a big story this year. I also like the fact that the free cash flow now has improved versus where expectations are because of the pent-up demand here that we've seen on the iPhone. As long as they can sustain some of this demand or the higher revenue trajectory, we really like it. I mean, they're going to give a new shot, an update to their capital allocation program in late April, early May. We expect a boost on that side of things. And then, again, the AI story we'll get more clarity on, especially as we get into the developers conference here in June. And then as you go to the fall, you're looking at potentially a foldables device launch alongside, a greater AI story there. And on top of that, we'll see how they handle the memory story. If memory prices go up as much as they potentially are indicated to go up, they can always adjust pricing, potentially by $50 or so.
Microsoft also reported stock started to sink right after that on the same concerns or something else here?
Yeah, as far as Microsoft is concerned, I mean, they were a little bit light on the Azure side. They actually beat our numbers. I actually think high 30s growth for Azure is still a fantastic growth number. So I think it's nitpicking a little bit. OpenAI obviously now becoming a bigger portion of their bookings. I think that spooks the street a little bit. You're talking about 45% of their bookings coming from OpenAI. But I think what's also important is 55% or north of 300 billion of their bookings is not OpenAI. And that business, on that side is growing about 28% on a year-over-year basis. So they are seeing some nice growth ex OpenAI, but the fact that they did highlight that large OpenAI exposure, I think spooking the street a little bit. But we would actually tell investors to be buying on this dip, given that the north of 10% decline that we've seen here over the last 2 days.
Okay, let's get to Meta. Going big, of course, on CapEx spending. We knew that. But do you think they're seeing some ROI now from curated ads on social media? Are they benefiting already?
Yeah, they absolutely are. I mean, you look at the guidance there for the March quarter, essentially at the midpoint, about 30% year-over-year growth. I mean, they are clearly monetizing AI at this point in time better than anyone else. I mean, we'll see what Alphabet has to say next week. But as far as Meta is concerned, they are doing an absolutely fantastic job. Obviously, it was a great quarter for them to significantly bump up their CapEx and OpEx number for the year. And I think it also kind of, the wide range puts in a worst case scenario where they're not going to have to tap the street again and say, hey, listen, we're going to have to increase spend. So they're set up pretty well here in 2026. But they do have to still deliver as we progress through the year. From those hires that we saw last year, we do need to see some new LLMs come out, and we need to see them really kind of hit a home run there with the developers.
Google, as you mentioned, will report next week, which follows the November launch of Gemini 3. Is Google winning the early AI race with Gemini?
Yeah, I mean, I think they are. I mean, we'll see what some of the updated user numbers are next week, the usage numbers, and how they're monetizing Gemini at this point in time. But, all indications right now is, they're getting, significant momentum from Gemini 3 here. And then, they can obviously kind of throw that across their entire ecosystem and really benefit on that side of things. So we think next week is going to be we're going to see some great numbers out of Google, not only from what they have to say about Gemini 3, but also as far as the cloud momentum. We're looking potentially mid-30s growth, which would be slightly above where expectations are. And then I think Azure and search. I think YouTube and search also does very well.
Okay, I've got about a minute left, so let's get to Amazon quickly. What are you expecting from Amazon?
Yeah, so our analysts actually, again, it's going to be all about the AWS business. It has been here. That's been the case here for the last couple of quarters. And, I know there was a slight miss on Microsoft's side of things, but our analyst is looking for a slight acceleration here from AWS. If they can demonstrate that, I think you'll get a different story and reaction to the Amazon numbers relative to what we've seen here from Microsoft. And not to mention, it is a slightly easier bar for Amazon to beat relative to what Microsoft has had to go against.
Angelo, got to leave it there, sir. Have a good weekend, and thank you very much for giving some of your time to us today.
All right, thanks for having me.
Up next, BlackBerry leaning into a new business model with a partnership with IBM. More in a moment. BlackBerry announcing its QNX division software will be integrated into BMW's new vehicle generation, so not IBM. CEO John Giamatteo joined our Bloomberg colleagues today.
We're actually up to 275 million vehicles that we power around the world with our real-time operating system. We're really pleased with the announcement with BMW, where we're taking that relationship to another level, and we're powering that with our advanced Ally Core capability. And this is an integrated kind of approach to really bringing together different layers of the stack. So our whole foundational vehicle software platform is powering everything that we do with BMW, and it seeks to really simplify the cumbersome and complex process of integrating software so our partners like BMW can focus more on delivering customer-facing applications that can build brand loyalty and differentiation. So that's the underpinning of everything that we're doing in the QNX, not only with BMW, but with all the other major OEMs around the world.
You know, as an American, I think of the major OEMs as like BMW, Volkswagen, Mercedes, Ford, GM. But of course, in China, there's a massive amount of EVs being powered by companies that most Americans have never even heard of. How does that market look? How does the TAM in China look to you as the CEO of a Western company?
Yeah, that's honestly, Matt, it's one of our fastest growing markets around the world. As you said, the explosion of EV, the explosion of technology that's going into these vehicles. Some of them have almost up to 500 million lines of code that are going in there, and an operating system like QNX with the software-defined capabilities, the safety certifications, which are increasingly becoming more important in a market like China, positions us really well for that to be a growth market for us in the future.
So is it helpful when, the Europeans collaborate with the Chinese, or when the Canadians make a deal with the Chinese and they set up shop outside of that country and in places where you have more access to put your engineers?
It absolutely is. The whole industry is really collaborating together. For instance, there's a company, a partner of ours in Germany, Vector, who's right at the forefront of us delivering this Allied Core solution. So you have a Canadian company, a German systems integration company, supporting OEMs in China, Korea, Japan, obviously Germany and the US. So it's a collaborative effort. Together is power. All of the industry really needs to come together and work harder as more advanced technology goes into the car.
We're looking at a slate of your partners, AMD, NVIDIA, Intel, and you put the software layer into this stack. Are you feeling margin pressure from the price increases for the hardware there?
We play on the software side alone, so the margin pressure on us, obviously OEMs are big, sophisticated companies that have large volumes that command, a competitive price point. But I don't think it's the same level of pressure that maybe some of the hardware providers have. We have a deep relationship with Qualcomm, with NVIDIA, with NXP, Texas Instruments, Intel. So the entire ecosystem, from the tier ones to the systems integrators to the silicon providers, we work in concert with them to deliver our real-time operating system on QNX.
By the way, I think about these boxes with 4 wheels that people buy and drive around just because I'm older. But a younger person would think about robots, or at least AVs. And I know you're also in medical devices. It seems like your software can power a whole host of devices. What's most interesting to you, or what's the biggest revenue driver for BlackBerry outside of automotive?
Yeah, 100%. A lot of the work and the development that we've done in the auto side of the business translates very nicely to the general embedded market. Verticals like medical devices, railroad applications, robotics is a particularly high growth segment. These are mission critical environments where system failures have life-threatening consequences. So a real-time operating system like QNX is purpose-built for those kinds of applications in solving those business problems. So robotics, medical instrumentation, industrial automation, we think that's the next frontier of growth for us in this industry.
What's your pitch to investors, John? Because the stock has languished. It's just gone nowhere really for the past couple of years, even with your dominance in the auto industry and growth in others. So how do you sell the stock to investors?
Yeah, we think we're really poised for growth in the future, Matt. It was one of these, the transformation that we underwent over the last couple of years. We divested subscale and unprofitable business. We simplified our operations by reducing layers and empowering the workforce and removing bureaucracies. That enabled us last year to get back to profitability and generating cash. Now we're really focusing on accelerating our growth into 2026. And as we accelerate our growth in the coming years, I think that's really when the stock is poised for a breakout.
BlackBerry CEO John Giamatteo in our Bloomberg colleagues interview there. Coming up after the break, the Bloomberg Originals doc that explores why the world is awash in cheap crude oil. Back in a moment. So why is the world awash in cheap crude oil right now when geopolitical tensions have been on the rise? And what does the glut mean for the global economy? Here's the latest Bloomberg Originals doc looking at that issue.
This is oil. Well, actually, this is a mixture of black treacle and vegetable glycerin, but it looks like oil. And while the real thing's being thrown around by geopolitical tumult from Iran to Venezuela, you can still buy a lot for comparatively little.
The early days of 2025, oil prices were closer to $80 a barrel.
Since then, there have been slumps and spikes, but still,
an ounce of silver is now worth more than a barrel of oil.
And the price of crude would be even lower if China hadn't soaked some up into its massive reserves. The stuff's cheaper today than it was more than a decade ago, even before adjusting for inflation. Pretty weird in a world ruled by inflation, and it gets weirder still.
We've seen this surprise or shock twist from the OPEC Plus alliance in turning its strategy on its head, from protecting the oil price to opening the taps.
There's a massive oil glut out there at the moment. We're not short of oil.
The irony is that climate risks are accelerating, but the system's finding reasons to produce more oil. Recent developments in Caracas and Kazakhstan are only adding to price volatility in both directions. That's before factoring in tensions between the US and Iran.
One of the biggest changes that we have seen in the global oil landscape over the last 10 years have been that the typical correlation of crisis in the Middle East, higher oil prices, has broken.
So now an urgent question is taking hold. What happens when the oil market's assumptions break down? Let's just get ahead of something here. Many people are disinclined to mourn big oil's difficulties or the budget pain of oil-rich states. But the reality is oil prices shape costs and decisions for all of us.
When we drive, when we fly, when we get on a ship across the ocean, pretty much everything in your pocket, your mobile phone, pens, anything that has a plastic coating on originally came from a barrel of crude oil.
When the price of oil goes up, inflation goes up, and central banks have to intervene, increase interest rates, which can bring unemployment higher, it can destroy value in the equity market.
The oil price matters in part because it's a sign of the functioning of the global economy.
And here's the thing. Prices have been on a roller coaster over the past few years.
Brent crude, which is what we call the benchmark for the global oil price, it dropped 18% last year. That's the most since the pandemic.
During the pandemic, what we saw was a true emergency.
A swath of global oil production completely shut down when prices went below zero.
But then, in 2022,
following the war in Ukraine, we had prices rising to $140 a barrel.
And now that hydrocarbon-rich slurry of prehistoric plankton is down around $70 a barrel, a price that's been bolstered by the latest in a string of spikes as traders fret about US pressure on Iran. But when it comes to the broader downward trend in oil price, this time is different. And the reason, which we'll explain shortly, is causing particular concern
for oil-producing economies like Venezuela, Iran or Russia, where the governments rely on revenue from the oil to go into their budgets.
You have OPEC nations who need oil prices well in excess of $100 a barrel to cover their spending plans.
Those are the members of a coalition of producers led by Saudi Arabia. The average forecast from major banks puts oil prices at around or just below $60 a barrel this year. For countries like Saudi Arabia, that's well short of the break-even price their economies need. The discrepancy is even greater for Kazakhstan, Algeria, and Iran.
They're going to get less tax revenue. Then the oil companies, surely, and anyone who works around the oil companies are going to suffer.
And in fact, they already are.
The first wave of cuts that we've seen has been more geared towards non-core businesses. So the companies that have sort of reached out into the power markets, into utility sectors, and reining in some of those investments.
There's precedent for this. In the late 90s, back when TV news footage was annoyingly grainy, oil dropped below $10 a barrel. It prompted companies to even fire the geologists they relied on to find the next big field.
We have not seen that yet, but there is always a risk.
Okay, so why is all this happening?
The drop in oil prices this time is very different to the one we saw in 2020. The driver this time is oil supply.
Guyana is a country which a few years ago didn't produce any oil at all.
And today it produces close to 1 million barrels a day. That makes it a significant global producer. Even Argentina is having its own mini shale boom at the moment.
Other countries like Brazil, Canada, and even the US is pumping at record levels.
A decade ago, the US was unable to export to global markets. Today, it's exporting an enormous amount of oil, sometimes 4 or 5 million barrels a day of crude oil to global markets.
To put this into some context, for 75 years, the US imported as many as 14 million barrels of oil a day to fill a deficit. But America's domestic shale production boom has flipped this to create a surplus. And there it is.
We simply have too many barrels of oil hitting the market, arriving from every corner.
The International Energy Agency estimates that supply is going to outpace demand by about 4 million barrels a day this year, perhaps slightly less. To put it in context, imagine 2 giant supertankers, the biggest types of ship that can carry crude oil, popping up off the coast of the UK or off the coast of Texas in the US every single day for the year. That would lead you by the end of the year to have something like 300 to 700 tankers sitting there doing nothing because they're not needed.
Output from OPEC nations, led by Saudi Arabia and Russia, has also surged.
That started in the first half of last year, sort of accelerated over the course of the year, surprising the market, surprising traders.
It's like, why? Why you will increase output on an oversupply market? And I think that the reason is that they want to regain market share. They are going to compromise for a period, accepting low oil prices in the hope that over time, the supply will come down from other sources and that there will be more need for OPEC oil. But that's a big bet, and it's a bet that can be completely derailed if President Trump gets control of the Venezuelan oil and is able to, over time, develop that resource.
And that's a story for the back end of this decade, for 2029 to 2030. Trump himself has been saying that it's going to take a while for Venezuelan oil to meaningfully return to where it was in years past. And there are some in the oil market who think it may never get there, but it's going to take a significant amount of investment to see a major increase to the tune of several 100,000 barrels a day in Venezuelan output, that's for sure.
But here's the thing about those barrels.
We only need the market to perceive that they are coming to that have an impact on the oil price.
Another data point that we look at is what we call oil on the water. So that's a count of the barrels that are either transiting around the world, getting to where they need to be, or else in floating storage. And that tally has increased over the course of last year. Part of that is that oil from sanctioned countries like Russia, Iran, or Venezuela might be finding it a bit more difficult to find buyers.
Let me remind you that oil supply glut is floating in dark fleet ships in places like the South China Sea.
One of the biggest drivers of global oil markets in the last year has been the difference between sanctioned and unsanctioned oil.
Something made all the more significant during the first few weeks of this year, given threats to Iranian, Venezuelan, and Russian supply.
Russia certainly has some difficulties selling its oil as a result of the sanctions and restrictions that we've seen placed on its production.
As sanctions tightened on Russia following its full-scale invasion of Ukraine, a shadow economy emerged, utilizing that so-called dark fleet of aging, uninsured tankers. By repainting names and faking flags, switching off their transponders, these ghost ships vanished from the map.
Initially, there were only a few of these tankers. Today, probably 20 to 25% of the global oil tanker fleet is what we call the dark fleet. Most of the customers of that oil have been in the global south.
They don't really go into the places we normally look at to set global oil prices.
For instance, China, which hoovered up millions of barrels in 2025 into its vast stockpile. Some of that is Russian crude, which the war pushed into the shadows. But if the conflict were to end, it wouldn't stay there forever.
So perhaps the biggest change of a peace deal in Ukraine would be the return of some of those barrels into more transparent, more Western-linked pricing hubs, and that could weigh on oil prices.
The Trafigura Group, which is one of the world's biggest independent traders, a couple of weeks ago came out with a prediction saying that we're at risk of seeing a super glut.
And that matters, because oil prices don't stay confined to trading desks. They seep into our budgets, our travel plans, and whatever's in our back pockets. They shape how much oil the world uses. And while the market can discount a barrel, the climate can't. That cost can be expected to keep rising.
All right, that does it for the close. A quick look at the TSX and where it ended the week with that steep stumble of 1,100 points, taking it under 32,000 for the weekend. We'll see you back here on Monday.